Sorry, I can't stay for.
No, you're good.
I'll sing it.
No worries at all. So I don't think this class is gonna be the whole length that they're giving me, so I'm gonna make it like an open discussion with what you guys want me to talk about. First things first, my name's Liv. If I'm ever in trouble, you can refer to me as Livia, my legal name. I just only do that if I'm want. Been a guaranteed rate since May of 21, been officially with Jason and his team since January of the following year. So do a lot of business in the city. I live in the city, so I'm kind of the boots on the ground girl. But I also grew out right on the border of Pennsylvania and Delaware, so I know a lot about kind of the Delaware towns, shore towns. We have a team, we're the biggest team in our Philly branch. There's 11 of us total. There's 5 salespeople, so people like me, and then we have 6 operations people. So we've been together since, Jason was in the mortgage industry. We've kind of grabbed people as we went from one company to the next. But we're the biggest and we like to say the best team in Philly. So both personality wise and kind of work wise, we're the loudest and we're the ones that will make sure that we get things done on time. So this is just kind of a brief overview of some of the things that we do. I always like to say that when, you guys get people under contract, it's kind of a handoff. You hand off your people to me and then you trust me to make sure that we both get to the closing table. So if you haven't bought a house in the last couple of years, a lot of these things you're not really used to. You're not really in the mix with the clients as they're going through some of their loan things. You're not, speaking to underwriters as much as you might be. So this is just a couple of our programs that we can kind of intertwine with your daily sales pitches and to help your clients feel as comfortable as they can throughout the whole process. So all right, so just a brief overview. These are one of our most popular processes that we have with all of our loans. So when you get somebody under contract, it's kind of day one. I talk to them. I introduce myself. It's probably not the first time they've talked to me. They've probably talked to me a couple different times throughout the pre-approval process. I like people to have numbers with every single house you're showing them. It's a lot, but I don't want them to walk into a house, fall in love with it, and I have to tell them they can't afford it. So I should be talking to your people, a couple of different times throughout kind of the home search process. So they're comfortable with all the numbers they're seeing, they're comfortable with the location, taxes, things like that. Once you get somebody under contract, we officially green light them. And I always tell people it is kind of like drinking out of a fire hose. You guys need information from them about inspections. You need them to pay for that. You need them to, start physically packing up their house. We need them to get ready for the appraisal. We need literally their financial life to be provided to us. So it's a lot. But these systems are put in place that it's as easy as it can be to kind of get them going. Because a lot of people specifically that I work with are first-time home buyers. They have no idea what the hell's going on. So the first thing I'll talk about is our power bid approval. This is our stronger pre-approval letter. It's a pre-commitment letter. I'll go into it in a little bit more detail. But in this spring market, if you're going up against a couple different offers on a house, this is what's going to put you ahead of everyone else. We have our same day mortgage. If you need a 14-day close, this is the option for you guys. We can close a loan legally in 8 days, but we're pretty good at doing it quickly. If we can get an appraisal waiver, if they can validate their income and assets electronically, we can have them conditionally approved in 1 day.
So that would just be for conventional loans?
Conventional, we can do it with jumbo. If they're doing like an adjustable rate mortgage through a local investor, they don't typically do same day mortgages. And if you're self-employed, they do not do it just because we have to calculate the self-employment income. But if you're kind of just a traditional W-2 employee, you use, a conventional banking that allows you to upload your documents electronically. And if an appraisal waiver is not super popular these days, just with the house prices increasing, but even our appraisal turn times are 3 days. So if you guys get under contract on a Monday, we order the appraisal on Monday, you're typically getting it later in that week. So there's a wide range of things covered in the same day trend. If you're a first time home buyer, you're counted. If you're not a first time buyer, you're counted. If you have real estate that you're holding on to, you can still do same day mortgage. Jumbo depends on location. Some states allow it, some states don't. But Delaware, Jersey, Pennsylvania, if you have a jumbo loan, you can do the same day access. How same day works is you get introduced to your underwriter the day you go under contract. I'll get into it a little bit more. My team has 2 underwriters that we use. We kind of filter them through. So I know my underwriter on a first name basis, and your client will know them as well. So it's actually a direct line of contact with the underwriter to the client to get the things that we need. So we kind of cut the middleman out, and then the underwriter that introduces themselves to your clients on day 1 will be the one that actually approves their loan. So it's pretty cool that they get to be with them throughout the whole process. Next, we have our flash close. This is something that came out of COVID when we couldn't physically be together during closing and signing documents. I'll go into, we have 2 different types of flash close. One is a full online notary, and the other is a partial. This is pretty standard with a lot of mortgage companies, so it's not anything groundbreaking. But it helps your closings go from an hour to 15 to 20 minutes. So it's actually really nice, and we prefer all of our closings to be flash close if they're eligible for it.
And that can be done with an attorney?
Mhm.
Okay.
Yep, we do it in Delaware down here with attorneys, Jersey's also attorneys. We just have to make sure that the law firm that they work with allows it.
Okay.
Some old fashioned, they don't really like the additional technology, just because some of the documents that they like to notarize, it's done electronically. But almost every single conventional and jumbo loan that we do, we have eligibility. Maryland, yep. So, and Jason and I also just got our Maryland license as well. So we're Delaware, Maryland, Pennsylvania, Jersey, and Florida. So you guys are kind of covered at the border level. And then we have our rate float down policy. This is super competitive right now with how volatile rates are. If you have somebody for a 60-day close, the interest rate that we tell them on day 1 is going to be a lot different from it is on day 60. So we like to get creative with how we plan on locking their interest rate in. Some people like to shop lenders, which we actually tell them to do, because I want to be the winner, but I don't want to be the only person you talk to. So I have them go out to other lenders, see, what interest rates they're seeing, see what programs they're seeing, and it helps us sharpen our rates so we can actually match or try to beat anything that they give us back. And that is, the float down is something that once you're already locked in and you see rates continue to drop, we can float you down for free before closing. So if you have a 60-day, 90-day new construction, 265-day lock, this is really lucrative where we can kind of test the market to see if there's going to be an option to get a better rate before closing while protecting you for your rate going up. So your interest rate is locked and it can go down with this float down. This works with a lot of investors. Each investor is different. So each investor will have a different pricing behind it that the lender will have to kind of calculate. But almost every conventional and jumbo investor that we work with has some sort of a rate float down. So that's really competitive, especially with the jumbo area with a lot of the bigger banks. They don't have that. So if you have people that are very sensitive on the rate, but they're also a little bit nervous about the market, this is something that can protect them, have a little bit of ease of mind, and allow them, if they do have a little bit longer of a close, to kind of be okay with how the market moves up and down, knowing that they're protected. And then VA loans, I'll go into it a little bit. Most lenders do VA loans. We take pride that we are the biggest team in Philly, Delaware, and Jersey that does the most VA business. Myself and a couple of our other team members call ourselves VA specialists. So we're really good with VA loans. We like to make sure that all of our veterans can take advantage of the program, even if they've already had one VA loan. So there's a couple of hidden mortgage tricks that we like to do, that if you already have a veteran taking advantage of the VA loan, they might have a bonus entitlement where they can actually buy a second home. So we waive our lender fees for all of our VA loans, and usually the interest rates are a little bit better. So we always like to make sure that if you are working with a veteran, talk to somebody about a veteran loan. And then last, personal loans. I know home sale contingency is like red tape, and I know you guys hate to have that when you're writing offers. We have a couple options that we can help you with if they currently own a property and you don't want to have it sold for the offer. We can do called a bridge loan or a swing loan. I'll get into a little bit more detail with that, but it is one of the best ways to remove that home sale contingency from your offer, and allow your offer to be accepted. Any questions off the bat?
The bridge loans, how much higher are they, as far as, interest rates and so forth?
So bridge loans are based off of the prime interest rate. So right now, I believe prime is 7.5. So what we do with bridge loans is it's an interest only loan, so the payments are a little bit smaller. I just did one a couple days ago for a $500,000 house and it was like $300 a month. So the whole kind of idea of a bridge loan is you open it to remove this home sale contingency, you close on the new home, and then you sell eventually that home, then you pay off the bridge loan. So you only have it open for.
So it's like a second mortgage,
The second mortgage. Yep, and essentially you're swinging the equity from one house into the
and
other.
it doesn't affect the rate of the other, let's see.
It does not affect the rate of the other home. The only thing that you have to be careful with is it does have to be included as a new liability because you will eventually be paying for it. It's helpful because it's an interest only loan that it doesn't affect the DTI too much. But if you have somebody that's on the edge of being able to buy something, like you have to be very careful with what you do. I'll get into the minutia of that a little bit more, but it is another appraisal that your client will have to do on their current house. So that's just another cost that you have to kind of remind them about, that they have to do 2 appraisals. One on the new purchase and then one on the current house to see what the home value is, so we can see how much equity we can pull out of the house. This is one of the most common things I talk to people about every day. This is one of the biggest things that wins offers, because I know in the city and some of the other more competitive school district zones, home sale contingency almost never gets picked. So I talk to clients who bought maybe during the pandemic when they had their 2% interest rate. This is one of the biggest conversations I have on how to kind of structure that to be able to keep both houses and then eventually sell the one. So, not different from any other loan. We actually do the bridge loan at the same time as the purchase. So if they give me a W-2, I take that for my loan, and then I'm the middle person to do the bridge loan. We have an in-house HELOC group, home equity line of credit group, that can do it. That is the fast way to do it. If you have a client that is taking advantage of the same day mortgage and they have a 2-week close, you can still do a home equity line of credit in those 2 weeks. If you go through our internal home equity line of credit route, all electronic, all fintech, you don't have to do anything. The only thing is those rates are a little bit different. They're a little bit higher just because the money you're getting is quick. If you have time, if you have 30 days, if you have 45 days, we have a couple local outlets that we work with these where their rates are competitive. So it's all about timing. It's all about how quickly you need the money. But we have a couple different options for people. All right, so our power bid. This, you'll probably hear me say it on a lot of phone calls as our pre-commitment letter. What it is you give me a buyer, they're telling me, oh, this is our 6th house that we put an offer in, nothing's winning, I don't know why we can't get an offer. I'll talk to them, I'll get some of their financial back history, and then what I do is I can kind of tell right away from an initial conversation if they're gonna be eligible for this program. Typically, when you have a very, low risk loan, DTIs may be in the 30s, both W-2 employees, not a lot of red flags. We give this out without even telling them what it is. We say, hey, you qualified for a stronger pre-approval letter, here you go. What happens is it actually goes through underwriting before you're under contract. So an underwriter will already see their documents. Typically, it's 2 recent pay stubs, a W-2, and a bank statement, and that's all I need to give to an underwriter to get the sign off that they're pre-committed, which means that their pre-approval essentially is in a higher, higher light. It's a different pre-approval letter, it's different language, it looks different, which means that if we do the flash close and if we do the same day mortgage with that pre-commitment letter, that's where you get your 1-day turnaround. And every time I submit a offer or I have people submit an offer with this, I always call the listing agent because they have questions about what this is. The number one thing that I tell listing agents when they have a power bid approval is underwriting has already signed off on all of the documents that were provided. That's huge with listing agents. We can do this with a soft pull, so people don't have to do the hard credit pull. We can do this pretty quickly. I have the power to print this letter, so if I think that the loan's in good standing, I give it out to as many people as I can. This is the best way, aside from, you know, a personal loan or aside from a home sale contingency, that offers get accepted, because it's a stronger letter from the lender proving to the listing agent that the client is in good shape.
So it's just like saying to the listing agent, like, this buyer has already gone through like several checkpoints in the
Yep.
loan process.
When we give you the letter, and I can show you a side-by-side comparison of like the pre-approval letter, which just basically says your client's in good standing. They're good based on their, you know, conversations about their financials. Some pre-approvals, we don't get any documents, so we just give it to them in good faith. This, I have documents, so I can see a bank history, I can see a work history. And on the physical pre-commitment letter, it says an underwriter has already signed off on all the documents. The credit has been through underwriting as well, and everything's been verified by a third party. And it's all in kind of clear cut lettering, and it's good for the pre-approval 90 days. As long as we have an updated soft pull credit pool, you're good for 90 days. So I like to kind of match the offer price with the letter. So if you're seeing a couple different houses with different price points, let us know, because we can change the price. But this is a really good way if you have that client that is kind of losing hope and they have a couple offers get denied. This is a good way that we can kind of beef up their buying power and show the listing agent that they're in good shape. So this has a super high success rate, and it's very easy. If they have their documents, you know, kind of filed electronically, they can shoot it over to an email, or we have an online portal they can upload their documents through. I look at it, and then it gets signed off from an underwriter, and then we're good to go.
Does that lock them in for their?
It does not. Nope, so there's no interest rate lock with this. This is just kind of like a pre-approval letter, just with a little bit stronger conviction to the listing agent that the client's been verified. If you have a new construction deal that's not closing until January of next year, we can lock in your interest rate. But this is a little bit different than that. Any questions on this one? Awesome. Same day mortgage. So this is the process that we came out with a couple years ago when COVID was kind of settling down and competition was ramping back up. Same day mortgage, we used to have a pod structure, which means that when we get a loan in, you talk to one person, and then you talk to another person, and then you talk to another person, and then you talk to another person. Now, we've cut those middle people out. You talk to me, one underwriter, and one team member for the whole length of the mortgage. The underwriter will give your client a full audited list of documents that we'll need. If they're divorced, we'll need a divorce decree. If they're paying child support, we'll need that note from the judge. If they are a sports bettor and they're having large deposits withdrew from their account, we'll have to have information about that. So we get super nitty-gritty on day one that we basically need to hear your story for the last 2 years, why you're making these payments, what you do for work, if you get paid bonus. So they'll get a full list of documentation, and it is submitted right to the underwriter. So as the underwriter gets documents, they're actively reviewing files. If we get an appraisal waiver, which means that the purchase price that your client is buying the house for is justified by Fannie Mae and Freddie Mac, you get an appraisal waiver, means you don't need to get an appraisal done. If we have that, and if your buyers give us documents relatively quickly, this is where you know that your loan is conditionally approved in a couple days. This is our most popular underwriting tactic right now. Every loan that we can put in same day, we do, because I'd rather let you guys know on day 10 of your 60-day loan that you're already good to go. This gives clients the availability of adjusting closing dates. So if you have a vacant home and you thought you just needed more time to get the loan underwritten, you can move up closing. If you think that you can do a same day, morning sell, afternoon buy, you can do that with same day too. So this kind of opens up a lot of doors where we tell people it's like a root canal, drinking out of a fire hose. The first couple of days, it's going to feel like a lot, but then they have 3 weeks between now and closing that they don't have to do anything. So it's kind of nice especially now with offers being denied or multiple offers being done, everyone's being burnt out very quickly. So if we can get all their documents and get everything into underwriting as quickly as we can, it kind of alleviates a lot of stress. So I'm not gonna have to ask for a pay stub the day before closing. I'm not gonna have to, tell you that we're not CTC yet because something happened, well in advance that you guys are good to go. Like I was saying earlier, most conventional programs are in this, aside for some of the grant programs. So if you guys are doing DSHA, you're doing state grant programs, we can't use same day. If you're up in Pennsylvania, you're doing PHFA, can't use same day. If it's a program that is double underwritten, meaning we underwrite it and then another person underwrites it, we can't do the same day. So a couple of our jumbo investors have that 2-time underwriting, so they're ineligible, but then we also have a couple in-house jumbo players that we can do this with. So the most important thing when you do get an offer in and it's accepted, I have to know the closing date. If it's a close close or a close commitment, we'll kind of use this as our back pocket to make sure that we stay on track for everything. If we have, 60 days, or if it's a commitment that's not for a couple months, we might not do this just because buyers think they have a lot of time before closing, so we may not rush. Client by client, case by case, but we'll actually have some agents ask us for a 1-day commitment, and that's what we'll do with this. So if you get an offer accepted on Sunday, you'll do a Monday commitment, and we'll be able to do that with this program. So this, along with the power bid, pre-commitment letter, hand in hand, this is kind of the magic that gets offers accepted and listing agents happy because, they have their deal already confirmed. And financing is kind of scary right now. Cash is king, it's always gonna be king, but if we can tell them that we have these measures, triple confirm that they're good, they're more open to hearing about financing.
So my question is, if someone's doing these like same day mortgages, are you seeing that buyers are more willing to waive the financing contingency?
Yeah, I talk to agents all the time about waiving it. Almost every deal right now in the city specifically is waived.
Yeah.
Not really in Jersey yet, but we're starting to see that with the change of the season, a lot of the mortgage contingency is being waived. We almost tell all of our clients, go ahead, like we're comfortable with it. My pre-approval, my team's pre-approval success rate is 98%. If I give you a pre-approval letter, there's 98% chance that that loan's closing.
Okay.
We haven't had one denied in years. The only reason why that 2% is still there is because of COVID madness. So if I give you a pre-approval letter, know that that loan will be approved unless something comes out of left field.
Like
Yeah, they're like secretly married and they didn't tell me that, like, okay,
Yeah.
we might have, stuff.
Yeah.
But this is kind of a surefire way to alleviate a lot of stress as well. Like I said, I talk to clients all the time and they're freaking out just because they hear on the news mortgage rates are dropping and, rising and falling and everything. So this is a good way to kind of tell them, hey, you'll know in, 3 to 5 days that your loan is completely approved, so you don't have to worry about any of that outside noise.
So once you get this approved and everything, and if they lock into their rate, can you still do the rate down
Yeah.
with this?
We can still do the float down. Technically, I can do a float down up until 3 days before closing. Because I just need to get the CD updated with the new rate, and I just have to have underwriting to just sign off on some of the changes.
And it doesn't cost them any.
Does not cost them anything for one time. If they do it twice, it costs them a thing. Yeah, it's usually not possible to do it twice, just because rates don't change that quickly. Rates change quickly negatively, so going up, they don't change that quickly going down. Yeah, it kind of things. But yeah, so same day, if you're hypothetically, today's the 16th, if you want to close by, next Wednesday, we could do that with this. Yeah, so it's pretty cool. A lot of title companies actually ask us about it too, because we'll ask for title docs like pretty quickly, just because we know the deal's active. So what it is, it's a sign off on everything internal. Sometimes we'll still need like a certificate, we'll need, the lien search done, we'll need, the appraisal back. But everything kind of in-house with the loan is what gets signed off on, and then we just wait for title to have their documents provided to us, so then we'll officially be kind of clear to close once all that happens. So you get an internal third of close with us, and then once the third party things come in, you'll get another third of close.
So if you waive the financing, but you have a limit required repair, is that considered a financing contingency?
It depends on the loan. If it's FHA, yes, because that appraisal is more invasive because it's a grander scope of safety concerns. Same thing with VA, that appraisal is gonna be a little bit more in-depth. So there's ways that if you waived financing contingency, but you kept like the appraisal or the inspection in there, you can use it for the inspection.
Or like the additional terms,
Or
at least
the
for
additional-
Delaware.
Yeah. So it depends if it's a conventional loan and like the appraisal didn't come up with anything, then it wouldn't be anything financial related. It all depends. And a lot of stuff we ask clients to let us know in advance. So if they're seeing a house and they're writing an offer and they're asking me about waiving, the mortgage contingency, I ask them, did you get, an inspection for information purposes only? Or do you know from the disclosures that the roof might need work or something like that? So I kind of ask them before they start writing the offer, like, what do you think is gonna come up if anything would have to? So we can be prepared for it.
Do you have a list of what they look for in the FHA and VA appraisal?
Yeah, we do. It's pretty,
Whatever they want.
Yeah, it depends on, I know it depends on the day and the person.
We just had conventional loan that they came back and asked for a railing to be put in for 3 steps.
yeah.
Yes.
It was like, yeah.
I just had a FHA come back for a broken window, I mean, a cracked window, but they missed a 35-foot deck out back that's completely rotted. What?
They thought it was a leak or something?
Dirty state apartment, they didn't like you that.
Yeah. I would say the most thing I see in an FHA appraisal is chipping paint. That's the number one thing.
I have scraped and painted.
I did a whole fence,
Okay,
backyard fence, my son and I.
Yeah.
did it.
yeah, we've had a deal too where, like, it was an old house in Delaware County. And 2 of the windows were painted over, and there was an older guy doing the appraisal and he physically couldn't open it.
Oh, yeah.
So he said that was a safety hazard. We had the seller go and try to open it and, yeah. So like stupid stuff like that, FHA will get you for.
Wobbly toilet.
Yeah. But going off of that, if you guys ever see like a stove missing or something like that, make sure you do that. Make sure you put just something in its place before an appraisal is proposed. That'll be.
Obviously a kitchen with a stove upstairs, downstairs finished with a stove.
Is it disclosed as like a basement?
So with USDA, we used to run it.
Yeah.
We're not allowed to do that. And I think, I'm like, it's still the deal. So
So-
a lot of people try to sell a kitchen,
Right.
whatever.
Sometimes you can say that it's like an in-law suite too.
Yeah,
It really depends if there's like a bathroom plus a bedroom connected to it. It really depends on a day by day who the appraiser is.
is
Yeah.
there egress?
Yeah, let's say there's a walkout
Okay,
and then.
So then that would be like the summer kitchen that would.
yeah,
So if there's like a back door entryway, you could, I argue that that would be a summer kitchen. Yeah, and what we do is, I don't have a slide on this, but when we do have appraisals, if you think that there wasn't a comp used correctly, or if you think the value is so far off, we can actually dispute the appraisal and get another one done. It does have to be approved to do so, so it does have to go to like a board to see if it's justified. But there's a pretty high success rate that if you think that the appraisal, either square footage is wrong, the price is wrong, the comps that you gave the appraiser wasn't used, we can always fight to get a second.
How long did that take?
If you give me the information I need, we can do it in a couple days, and then we would just get a second appraisal done. Your client will have to pay for the second appraisal done, so you have to be careful if you wanna do it or not.
All right, so,
And we do tell our client, every call I have with clients, we talk about appraisal shortage, what happens if that comes up.
You've been seeing it, I know appraisal gaps were pretty popular the past couple of years. And they kind of started to fall off.
I haven't seen it as consistently as I once did right after COVID. Right after COVID, almost every appraisal was coming in late and like significantly late. Now there's been enough time that most appraisals are coming in right at value or maybe a little more. That we haven't seen, and if it's anything light, it's manageable. But during COVID, we used to see like hundreds of dollars like swings, yeah.
Yeah,
So it gets pretty scary, but I talk to all my clients about appraisal gap coverage. And if you have a client who's putting more than 10% down, they're likely eligible to do appraisal gap coverage. What it means essentially is we use the lesser value when we're doing some of our numbers. So if the appraisal comes in light, our loan to value, our LTV now has to go off of the appraised value versus what the purchase price was. What we do with that is we'll adjust like the LTV percentage that your client is doing. Instead of, if you're doing 10% down, the LTV would be 90. It's out. So hypothetically, if you had a appraisal come in, $10,000 late, we would adjust the LTV to essentially cover that $10,000. So then they wouldn't have to pay anything out of pocket. They would likely, if they weren't doing mortgage insurance already, they would likely just have to pay a little bit more because it goes off of LTV percentages. But people always think that they have to shell out that money out of the bank when it's come in low. If I have an appraisal that comes in low, 9 out of 10 times, they're not changing anything in terms of more money to close in. They're just changing their financing a little bit so that they absorb. But that's why, going back the same day, if you do get that appraisal waiver, we even have, they're called ACEs, ACE. It's a different type of appraisal waiver where you still have to get the physical appraisal done, but it's an exterior appraisal. So they just go kind of like a drive-by if you ever did it during COVID. They agree with the value. They think the value is great. They just physically have to make sure the house is in good standing. And they literally just do it outside and walk around. That's more popular these days rather than a full PIW, a full appraisal waiver. But either way, we get the ACE or if we get the full PIW, it's quick and you guys will know.
And those are basically with 20% or more down.
No, not necessarily. It depends. We had one where it's just been a super populated area with a lot of like changing of ownership, where there's been enough sales in a certain, 6 to 12 month timeline where they've all kind of gone for the same price so that Fannie and Freddie have kind of justified that price is right. So it depends. Credit kind of goes into it a little bit. So if you have clients with, let's say maybe like a 740 and above, they're more likely rather than somebody with that below. Just because when Fannie and Freddie give you that appraisal waiver, they have to take consideration of your client's financial history. So it's not likely if somebody has probably below a 700, just because the risk of having the mortgage paid is higher with those types of people. So. All right, we have our flash close. Every closing that we do, we check first to see if it's flash close eligible. This is super helpful if you have clients that are traveling, if they're on vacation, if they're out of the country, if they're sick, if something has to happen, you always have some options if the file is eligible.
So, sorry to interrupt you.
Yeah.
They don't have to be in the same state that they're closing in?
Nope.
And that's allowed in Delaware?
Mm-hmm. Murphy's Law, I tell you, everyone's buying a house when they're going on vacation. It's the weirdest thing. It's case by case with the individual law firm.
Okay.
But yeah, I've had people like physically on vacation in Florida do a full remote notary and they've been fine. So how it works is, this was super popular during COVID. Almost everything was an online notary. It's case by case specific per state. So you go into the program with all of your closing documents. You will be placed with a mobile notary physically on like a video cam. So you'll justify your ID, a couple other, maybe like a passport or a social security number. And they physically will watch you sign your documents. I've done a couple in Delaware. This is more like down south popular, just because that's where people are kind of buying like second homes now. So a lot of people are starting to do like Atlanta, Savannah. So if you're in a destination where you physically can't get to the house, it's a second home, you can do this as well. So super convenient. The flash close, e-close 1 is the fully remote close. That will be the one that you're linked up with a mobile notary. We'll give you a time frame that the notary will be available for, and you literally just kind of join a Zoom call and pop up with the notary. they'll review everything with you. Your loan officer can also be in the call with you. And then all your documents are signed. That's more popular for the secondary homes or if you're physically not able to get to closing. We can also do a power of attorney if you're not physically able to attend closing, but this is the most popular as of right now. Flash code hybrid +2. This is the one that almost every one of my closings is. It's a partial electronic and in-person closing. They'll be able to see a full package of closing documents before the closing day. So they'll get a link, here are your closing documents, it's 110 documents, CD, note, mortgage, 4506, W-9, all the forms that they'll see at closing, they'll be able to review them electronically a couple days before closing, and then the morning of their closing, that link will go live, and they'll be able to sign some documents electronically, and then the rest will be done at closing. I had a client last night review their whole closing package with me. It took, about 45 minutes, and then we're gonna go to closing on Thursday. They've already seen the documents, bam, 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 they'll sign. They'll probably be in and out in 15 minutes. So this is nice because people don't like to take off a full day of work anymore for closing. So if you have, yeah,
It's the weirdest
it's
thing.
it's great, you're
It's like
buying
you're
it.
buying the house, take the day off.
Yeah.
Come on.
Drives me
Yeah.
bonkers.
Yep, so if you have that nurse or if you have that, client that literally can't take a day off and they have a 2-hour or 1-hour lunch break, this is kind of the best way to go. Because the electronic link that they get goes live at 12:01 a.m. So they literally can sign their electronic documents anytime between 12:01 a.m. and 11:59 p.m. Yeah, we like the electronic signatures to be done before closing so we can fund the loan, so you guys can get the money dispersed. But for some other reason, if they physically can't, they have until 11:59 at night.
Question, so a couple times at closing, the title will say, hey, we're not dispersing checks yet because. Yeah, the lender has to, there's a couple things, what normally is that?
So when you have closings, we have to sign off on everything that was signed. We have to make sure that the signature matches the person's name on their ID. We have to make sure, certain documents are dated. It's basic notary things, so we just have to double check that the documents were actually signed correctly. And then there's a couple documents that they have to check in order to disperse the funds. They have to check that both the mortgage and the note were signed. And then usually it's the CD, the Alta, and then some of the tax documents. As long as the signatures match what we have on file, they'll give funding
And that's
disbursement.
usually pretty, I mean, you guys do it pretty quickly. Like,
Yeah.
it's usually done pretty fast.
And what we like to do is Jason and I go to all of our closings, every single one of them. If it's out of the state, we still go to it. And I do my documents so that title can get the documents back to my team quickly so that they don't have to wait around for funding.
So it's actually, that's not considered dry selling.
Not considered a settlement. So dry settlements are typically with grants. So if you have like DSHA or PHFA, that's a second mortgage, they won't allow for a flat close. There's other grants like the Freddie Mae Borrow Smart that they can. Really just depends on the grant money. If you have a full dry package, they're just literally that thick with documents, so it's a lot. This one is a hybrid, so probably like that much will be signed at closing and then the rest will be their own. They can do it through their phone, they can bring a laptop to closing if they want. But it's super quickly and it's just like DocuSign, literally sign next, sign next. So we always like to kind of walk them through what they're signing a couple days before closing, so we're in it. And, kiss babies, shake hands, take pictures, and then go pay. If you don't have flash close, it's something that I like to alert title, because title, especially now, they have 8, 10, 12 settlements a day, so they like to know if they have a full mortgage or not. So that's one of the things that we'll prepare them for. But either way, if it's a flash close or a full package, I'm always there. So if there's questions, if there's issues with funding, if I've had a closing where I was on the phone with the investor the entire time, so we always like to be there in case anything comes up. Yeah. But this came right out of COVID. It's probably one of the best things that the whole mortgage industry has done. Almost every lender you probably worked with has something similar. But this is super nice, especially if the title company is swamped during a certain time, this kind of gives some leverage saying, hey, they already signed, 30% of their documents. It's not gonna be as quick as it usually is. So that gives a lot of peace of mind, and a lot of title agencies will actually call me a couple days before closing. And if I tell them it's a flash close, they get all excited. So it's really cool. We can do this with jumbo as well. The only thing is it's like a 80-20, meaning it's a 80 LTV front end and then there's a second mortgage for 20%. Those people don't usually do a flash close. And grant funds, specifically with state programs, they typically don't do it either. But almost every other program, adjustable rate, conventional mortgage, jumbo, 1031 exchange, those can be done through this. So it's really nice. All right, the float down policy. This is one of the best things that I keep in my back pocket to be the lender of choice. A lot of people want to know that their rate is always going to be the best case out there. Float down policy, each investor is specific, but Fannie and Freddie are pretty consistent with their, it's a 0.25% is what opens the door for this to be possible. If it's more than that, that's great. We'll float them down to as low as we can get them, but it has to be at least a quarter better than what they're locked in to allow them to think of the possibility of doing the float down. There is a fee, but the lender pays it, so the client doesn't have the fee at all. We absorb it in some of our back-end pricing. It's something that we like to be lucrative with, and the client doesn't see any of those costs. If it's aggressive, if they want like a full percentage better, that would be a case by case where they might have to pay an upfront fee just because the gap is so wide. But almost on every float down, the lender absorbs the full fee to do so, and they can take advantage of the better rate. Yeah, it's really nice. Even jumbo lenders, some of the state lenders, they allow them, like, I don't know if you guys work with Citadel or TrueMark at all, those are local credit unions. They even have their own float down option. So if we're working with, a different investor than just typical Freddie or Fannie, a lot of people have kind of adapted this because they've been losing competitive advantage by not having it. So almost every investor that we work with specifically has this program so that your client can always get better rates. It's something I sell on day one. I tell them I'm gonna lock you in right now because I'll show them a picture of the mortgage-backed security market and I'll show them this is today and this is how much the rate has changed. This gets people to lock in because they get scared that their interest rate is gonna increase. Then that kind of allows me to keep things going knowing that their interest rate is locked in. It allows them to stop shopping because most of the other lenders they're working with does not have this float down policy. And then I literally have a list of clients every day that I check periodically to see if they have the option to float down. If they do, some clients like to talk about it before I officially put it into action. Some clients just want me to do it and as best as I can give them the good news if it works. It does take a while, so if I put a request in for a float down, it usually takes a day for it to be completed. Which is why I need, at least 3 days before closing to be able to do it. But I literally printed CDs at title offices the morning of closing because we floated our client down. So if I can do it, I will do it. And I always like to kind of be the hero when I get to do it.
How much, so, I'm good with this, but if somebody wanted to lower the rate, they have a 6.75.
Mhm.
And they wanted to go to like 5.75, they wanted to buy the rate down. Is that they have to pay 1% of the sales price?
Yes.
Okay.
Mhm.
And
If they
Per percentage? No.
No, so typically 1.1% of the loan amount is a quarter to a 0.5% in rate. Yeah, so it's not a 1-for-1 drop. Yeah, so anytime you have points above, I wish it was, I'd be telling people 5% or 5. It's, when you price interest rates, you have the physical interest rate and then there's a price behind it. It's out of 100 and then you price at 100 and then if you're at 99, 1 point. Typically 100 will be 675 and then 99 will be maybe like 6375. So it's not that big of a jump. Some lenders price their interest rates different. So some lenders, they price it by quarters. So 7, 6, 7, 5, 6, 5, 6, 2, 5. So that's a bigger jump. Fannie and Freddie is smaller increments. So it's gonna be 7, 699, 6875, 675. So there's not as much bang for your buck that way versus if you're in like the jumbo sphere, or if you're with another investor that prices their rates differently. What I like to do is when I talk to, new buyers, I show them a couple options. I never show them one set of numbers. I always show them a couple. First thing I do is if they're unsure about a down payment, I'll show them maybe 3 options, 10%, 15%, 20%. Or if they're first time buyers, 3%, 5%, and 10%. That kind of gives them a good idea of where they want their monthly payment to be. And then once they have a general idea of that, then we get into, okay, so here's with no points, here's with 1 point, and then that kind of narrows their search down. There's another thing that if on day one, they lock in on a 30-year fix and 3 days before closing, they want to do an adjustable rate, we can switch that as well. So we always tell people that if they're unsure about things, but like the market's running, hey, I'm gonna lock you in just for protection. But if you want to change down payment, closing, or loan structure, point versus no point, we can always change that even after they're locked in. So people get scared by the locked in language, but it just physically locks in the interest rate. Everything else, including the interest rate, can always be.
I know last week everybody was freaking because they were recalculating everybody's loans.
Yep, on Friday,
So-
I sent out a mass. I did, when it's time to refinance, I always show them this is what you're currently paying, this is what it will be today. I probably sent 30 people a snippet of it, and if they didn't tell me within that day, they lost their opportunity, because that's how quickly things changed. So
How did it rebound or?
it came back up. Yeah, so if you're a jumbo client right now, you're probably in the mid-6s. If you're a conventional first-time home buyer, you're probably touching 7.
What constitutes a jumbo?
Loan amount. If
What?
you're over 806,000, that's the cutoff. Yeah, so if it's 806,500. So if you're over that, you're jumbo. If you're under that, you're conventional. And we see instances where we literally put their loan amount $1 under so that they're considered conventional. But sometimes based on interest rate, down payment, some of their other history, it might be better for them to do a conventional rate rather than a jumbo rate. So it all depends. Specifically with self-employment people, jumbo gets a little bit hairy because they need a certain amount of tax returns to be able to be considered as self-employment income. So if underwriting is strict, that's where we get creative with the loan amounts, put them in a product that won't ask for some of that stuff.
For self-employed people that are qualifying for jumbo, how many years of tax returns do you need?
Depends how long they've been self-employed for. If they've been self-employed for more than 5 years, we only need 1 year.
Okay.
If it's less than 5 years, we need 2. And then if they just recently became an owner of a business, they have to show ownership for 2 years. Yeah, I have a client right now who is a dentist, and she just bought into the dental practice last May, and we can't use any of her income because she's only been an owner for 7 months. She's making more money than she was before. It's all about timing. So for her instance, we even tried to see if we could get an exception, because some programs will allow 1 year of ownership. But because she bought in May and it was only 7 years of tax return, or 7 months of tax returns, they won't accept her income. So if you have self-employed buyers, it's always important to know when the business was established, how much ownership they have in the business, and then if they pay themselves back on a W-2. If they don't, then you have to kind of get creative with calculating their income. So. And then this is just an example of what I show my clients. This is MBS Live. This is the software that I pay to have minute by minute mortgage security updates. Each line is 1 day. So you can see when the line is longer, it's been more volatile versus when it's been shorter. Obviously, green is positive activity, red is negative activity. You can see that there's been some huge jumps where we've gotten really good momentum, and then it always kind of stabilizes before there's another uptick or downtick. When I have people that are either unsure if they want to lock or if they're going between a couple different lenders, I will literally screenshot this and send it to them in email and tell them you're safer locking than you are kind of waiting it out. We always kind of justify when locking and floating is the right play. Right now, because of this volatility, this is the last 3 months, we lock people in. So I even have, high-end executives on a call with me to go over this because they're very interested to see how it's traded. It's like the stock market, but it's different, so it's bonds being traded and mortgage-backed securities versus stocks. So I hate to say it, but when negative things are happening in the financial world, it's usually really good for mortgages. So I have to kind of cheer for like a bad employment number and a good unemployment number. And if there's something overseas happening that is not good, it's good for us. So we have to really kind of teeter a line where we not celebrate things, but if we see news about anything kind of major, we get on with some of our underwriters and secondary people who price our interest rate to see that how it affects our day-to-day interest rates. Rates can also be repriced during the day. So if you see, for example, when Trump had his tariff conversation, he had that at a press conference in the middle of the afternoon. That made mortgage-backed securities kind of react, and we had a midday rate reprice. You can have a rate reprice for the good, which means that your interest rates get better. You can have one for the worse. You can have more than one during a day. So if you guys have somebody under contract and I don't get the agreement until late in the afternoon, we might have missed out on a couple of reprices during the morning. So as soon as you tell, or as soon as people get under contract, even if you verbally tell me, we can lock people in if it's super volatile. But we can't lock them in until we have notice that they're under contract. So if it's late Sunday night, literally shoot us a text or an email saying that they're under contract, so we can see if we need to lock them in or not. But it's crazy. I literally have this up on my second monitor all day. I have like news will pop up if somebody's speaking, if like the Treasury Secretary is talking, if the Fed's talking, if Powell's talking, if Yellen's talking, like we get notified all the time and we literally see a minute by minute tick with how rates are going.
So are the stock people, or the people that are buying the bonds and stuff, are they just sitting there like ready, or they?
Yeah, think of like a day trader.
Yeah.
It's kind of like a day trader with global news. So as news comes out, they kind of react to that and they essentially, this is what our secondary team goes off of to price our interest rate sheet each day. So it's always the first 2 hours of the day, we don't have an interest rate. We don't have rates until about 10:30, 11, because our secondary team is reacting to overnight news and overnight activity, and then they're pricing an interest rate sheet for us. So we have overnight protection, which means I can price people in from the day before up to a certain time. And then there's a couple hours where we're waiting for a rate sheet, and then we get one we can go to protect as many people as we can.
So like those big. Are there like a percentage difference?
No, so this kind of goes back to how the rates are priced, so like that 100 scale, 99. So if like a day with this, we'll probably start, I believe a couple weeks ago, we had a day where we got 3 reprices for the worst. So it's not physical interest rates that are changing, but it's the price associated with it. So you can have the same interest rate, you may have to pay just a little bit more for it. Yeah. So a lot of stuff that you guys don't necessarily need to know about, but clients will ask you. Clients ask me all the time what a 2-bedroom, 3-bath looks like in certain township, and I have no idea, and then they're gonna ask you about interest rates. So if they ask you and you have no idea, I talk to people every day about it, so send them my way. We'll be able to ease some minds, because this also keeps us ahead of the local news and the national news. If you see the news is talking about interest rates or anything housing related, they're usually 2 to 3 days behind of us seeing it in real time.
Do you post this anywhere, like on your Facebook, like daily, or to keep everybody up?
Yeah, so I do, everyone on my team does a weekend rate sheet email. We'll send a rate sheet with all of our programs, and then we'll talk about something mortgage related in the week. A lot of times, this is the main topic of discussion because it changes so frequently. But I can add you guys to my email rate sheet so you can see each weekend where prices are.
Right.
It is a lot, but we kind of hold people's hands so that they can feel as comfortable as they can, because there's a lot of moving pieces on your side, on my side. So as much trust and faith we can put into clients is kind of the. This is, what is this? This is our agent advantage. Connor was talking about marketing a little bit earlier in your sales meeting. We have something similar. So if you guys ever want to be co-branded on a rate sheet, a property flyer, a just listed postcard, or something like that, we have a way where you can sign up, put your headshot, put your information where we can give you open house flyers. We can give you things that are co-marketed so you can start putting some stuff out with financial scenarios, rates. So if you guys are interested, it's super easy. We just need a couple pieces of info, you know, name, address of the brokerage, headshot, phone number, email, and then if you ever have an open house coming up, or if you want a rate sheet with your name on it, we can make sure that we give that to you guys.
What's the turnaround time?
That's a good question. So it depends what you want. If you want like an open house flyer with maybe 3 pricing scenarios, maybe an hour or 2. If you just want something like a postcard or just sold flyer, that can be a couple minutes.
You guys sharing the cost of the postcards and stuff?
If it's co-branded, it's 50/50.
Okay.
Yep, so if you wanna target like a certain area that you just sold a property and you wanna get the neighbors, you know, postcards, we can do kind of a mile radius and then split the cost with you.
If you're on a team, it would be like 50 for you and then 50 for the team. Okay.
Yeah. So, this is property flyers, single property websites, data management. If you're interested, we do a lot. Specifically, we do open house flyers. That's like the main thing that we do. And then the postcards are another thing that we do, even if it's just, you know, you have a new neighbor, congratulations. Like it gets people thinking about maybe listing their house or curious about what you sold that house for. And then the last thing, personal loans. This is a way to avoid that home sale contingency. So we have just a traditional HELOC. This is a line of credit borrowed against the equity of the current home. It's called a swing loan or a bridge loan if you're using that equity for a new purchase. This is something we do all the time. I believe the lowest is 15,000 and then the highest is 400,000, but that's case by case. If you have somebody that has a ton of equity in their house and they want to pull it for this and buy $1 million house, we have a couple one-off investors that will lend a little bit more. This is a loan separate from the home purchase. So they have to be approved for this separately and then also approved with the new purchase in adding this into their loan. It's an interest-only payment dependent on how much they draw. So if they did only 15,000, they're not paying that much each month. If they did, you know, more than 400,000, it's gonna be, you know, a good chunk of change. Most clients will do this as a short-term loan. So if they want to buy their dream house, they'll pull this out. Use the proceeds from the home equity line of credit as a new down payment or closing costs or, you know, funds needed for the new loan. And then they'll sell the property that they pulled that line against. And then as soon as they sell it, they pay off the existing mortgage. And then this is a new secondary mortgage that they have to pay off. And then they don't have a loan anymore. So it's super popular when people are either jumping school districts and they want to increase, you know, square footage, or if they're relocating for jobs and like the market that they're coming from versus where they're going is a little bit higher. So this is super competitive with removing that home sale contingency. As long as the appraisal is approved and there's no repairs needed on their primary residence, it can take up to 14 to 30 days to get that loan approved, and then they won't have a home sale contingency. We have a fintech home equity line of credit that they can do it in 5 days. So if you need the money really quickly, that's the way to go. If not, we have a couple local credit unions and investors.
So you said to get it approved, it takes that amount of days, not to get the actual funding.
Both. So the approval,
So it should be done way before they start looking, basically,
we like people if they're,
because then you do have a financing contingency.
Right.
For up to that amount of time.
if they're telling me that they want to buy their dream house, that's the first thing I talk to on my pre-approval call. I tell them about the bridge loan even before I talk about their pre-approval. I've had one approved and funded within 12 days. So we say 30 days kind of as just a safer, more conservative option. But if you have somebody that is actively putting offers in, but they need cash, we kind of jump in right away. We'll order the appraisal, we'll get some of their documents so that we know they're approved before they're offering.
They would take a 50,000. But they were gonna make 200,000. So
Mhm.
they could take a HELOC, get for the 50, get this house.
Yep.
Sell it, take the proceeds, pay that off. And that
And then,
kind of the general.
Mhm. Yep, and then. We call it a bridge or a swing just because that's kind of the literal term of what they're doing, but. Essentially, if you have people that also want to do some home improvement in their house, they can always bump up the amount of equity that they pull if they can cover it. So if they are buying maybe a fixer upper and they don't want to do like a renovation loan, but they want to pull some equity out of their house, they can do that. And then they just have to sell their house in, typically it's a 6 to 12 month period because the bridge loan is only a 12-month interest only cycle. So they typically have up to a year to pay off that loan, so.
And for the equity, they can only pull up to 80% out?
Yep, it's 80% of the outstanding balance of the mortgage. So what we'll get is, we'll get the appraisal, we'll subtract the outstanding balance of their mortgage, and then 80% of that value is how much they can pull out.
If somebody had $100,000 house,
Mhm.
didn't know anything, they could only pull 80,000.
So it's like harder to do with someone that's purchased their house recently. If we're
It's
talking about.
Yeah.
It's the years left on the house, you're trying to. But if you're, an empty nester with kids in college and you lived in the house for 30 years, you have a lot of equity. And it depends too, what you bought the house originally for. If you bought it within a year or two for 400 and now the market's exploded and it's worth 600,000, we take the most recent appraisal, subtract it from the balance, and then we pull the equity.
What's the percentage on the loan?
It's an 80%.
No, I mean like.
The interest rate?
Yeah.
It's with prime, so prime changes, anytime the Fed cuts rates, they're cutting the Fed rate. So right now, I believe it's 7.5. And it depends, some investors, if you're pulling out more than 400, it'll be like prime plus. Or prime plus 1. But most keep it at prime because they know that their money's gonna be paid back in, a year long.
It's done for an investment.
Depends, it can be, depending on the investor that you go with. You're kind of pigeonholed there because you can't really shop around for it, because most lenders don't do investment property, swings, but we do have a couple outlets that do it. So the terms are a little bit more unfavorable just because it's so unique. But yeah, you can absolutely do it if you're buying.
If you're a client. 300,000 in equity,
Mhm.
and they wanted to use some to buy an investment property. You're saying there's out, you guys have outlets that could do it?
So what Lori's asking is if the property that they're pulling the equity from is already an investment property. We can do that if you're buying, if it's your primary and you're buying a future investment, that's kind of like the usual way of it, so there's no difference. Yeah, Lori's asking if this is currently an investment property. Because traditionally what you would have to do is you would have to do a cash out refinance. Now there's a handful of local lenders that will do up to a certain amount for investment properties. So we have a lot of programs, a lot of unique programs that are specific to certain people. If you think there's not financing for your client, there probably is. So kind of get us in the mix early. If the swing loan is something that you're thinking of, we'll need a couple weeks in advance just to get that in motion. But if you have self-employment, if you have new construction, if you have a 203K renovation loan, if you have somebody that has, foreign assets that they need to convert it into US dollars, anything unique that you can think of, we probably have a program for it. So. Any questions? I know it was a lot.
So any of our existing clients right now that would be inquire, do you guys do equity? Product?
We have standalone home equities, if they don't need the first swing loan, they don't have to.
Right.
We do standalone, and same thing, we would either put them through the 100% FinTech just to see how much they would like to take out. And then we have local programs as well that we can kind of like compare rates to. Yeah. But lots of options out there, it's an interesting time to buy, so any questions?
And then the other thing is, you said you just got licensed in Maryland. Do you guys participate in any of the bonds?
Local state programs?
State programs?
Yep, we do. Yep, we are a local lender there, so the company as a whole, in all 50 states, so any state that has a grant program, we're good for. Us specifically, we just got our Maryland license, so we now individually can do those. before we had ever even
Refer it out.
the branch that we would refer it to. Yeah, so, and then same thing, if you guys have people that are buying in a state that I'm not local in, I can still, or not licensed in, I can still kind of be the head of the deal. We would have somebody licensed do all of the interest rate pricing and the, you know, legal signatures of the documents, but I can still be client facing for questions, anything like that.
This might be intrusive, but do you guys get referrals the same way that real estate agents do?
It depends, that's a good question.
Okay.
Some of the bigger teams will pay for them. So
Okay.
for example, since we're such a big team, we
Yeah.
do pay for them based on other teams.
Okay,
It's a case by case kind of realtor specific. Sometimes we'll help with Zillow leads and we'll split those costs with you guys. Sometimes we'll do like the Zillow Flex where they come to us afterwards. You know, Redfin, we'll do some of those different things, but I would say probably for my team specifically, most of the leads are organic with maybe 20% through Zillow or online.
I meant more like for example, if I had a family member that was looking to buy in like Arizona and I
Mhm.
recommended your name,
Yeah.
would you get a portion of that deal still in Arizona?
I would.
Okay,
Yeah.
that's what I wanted to make sure.
Yep, so we have, it's called a DLO desk. It's somebody that's licensed in all 50 states.
Okay.
And they would do all of the kind of back end underwriting and interest rate pricing. But then if we went through the DLO desk, we would be able to still be with them and then we would get a smaller portion of the deal. Yeah.
I've had a lot of people go to Arizona recently.
That's not true.
Really?
Yeah.
That's awesome.
Yeah. I have a couple good friends that are still realtors out there.
Really, I've done a few referrals back and forth from Arizona, and it's always like the Scottsdale, Phoenix area. And I just went
People are retiring.
January.
Yep.
Always.
Yeah.
People that love to golf.
Like high heat, so like they don't have the humidity.
And the hurricanes,
I went in January and it was like 75 to 80.
Really?
Yeah.
I went to the Grand Canyon once. It was a family vacation we did years ago and
Yeah.
it snowed at the
Oh,
Grand
really?
Canyon.
Yeah, we had
That's
the
craziest thing.
It's one of those things like, you know, see the whole
Yeah,
been there, done.
pool.
and it was like, we got this like. Previous thing. Yeah. Arizona's always kind of an interesting, I never know what it's gonna be like.
Yeah, I had to break so many different types of clothes. Like in Scottsdale, I can wear this. In Sedona, I can wear this. In the Grand Canyon. I can wear that. Yeah, it was.
Yeah.
Good class, Liv.
Thank you, yeah, so we'll do this once a month, not specifically this content, but if there's anything that you're hearing with agents or experts, let me know and I can. Thank you.
For a 2 or 3K. It's the best.